Hello and welcome. In this lecture video, I'll pick up where I left off on talking about the end of period interest adjustments for notes receivable and then do some quick check problems, okay? So I'm on page 202 of your course pack. And so remember what we were talking about in the end of the last lecture video. On December 16th, TechCom accepts a $3,000 60-day 12% note from a customer and granting an extension on the past due account. So because this was on the 16th, on the 31st, we have to recognize 15 days worth of interest, which also comes out to $15. And the way we got that is we took the 3,000 times our 0.12 times 15 divided by 360. And so on 12/31, we debited our interest receivable for $15 and we credited our interest revenue for $15. And we can recognize this interest revenue even though we haven't gotten paid for it. We'll get paid for it in the next accounting period, okay, on February 14th of the next year. That's when we'll get paid, but we can still recognize interest revenue in this accounting period because of the revenue recognition principle, okay? So let's look forward to the next page on February 14th when TechCom gets paid, okay? Let's look at that journal entry. So come over here and we're going to figure out what's the total amount of interest that they're going to get paid. Because remember, they're going to get paid in cash, so we'll debit cash, but how much are they going to get paid? Take their 3,000 times my 0.12 times my 60 divided by 360, which gives me $60. Okay, so I'm going to debit cash for my principal plus my interest, because we get paid the principal plus the interest on the maturity date, which is on the 14th. Okay. Then I will credit notes receivable for the principal, which is $3,000. All right. And then, remember we set up that interest receivable at the end of the last accounting period. We debited, I just showed you that, debited interest receivable, credited interest revenue for $15. Well, they're paying for us for the interest, so we no longer have the interest receivable. Interest receivable is a current asset on the classified balance sheet. How do I decrease an asset? With a credit. So I will now credit my interest receivable for that $15. Now I'm missing a credit for $45, right? To get up to that 3,060, I need $45 more in credit. What do you think I credit? Well, I credit interest revenue, right? Because from January 1st until February 14th, I've earned an additional $45 worth of interest revenue. How did I get that? How did I get $45? Well, the easiest way is say total interest revenue, right, is $60, which we did up here. You recognize 15 in the first year. That means you've recognized 45 in the second year. So now I will credit interest revenue for $45. And that is my journal entry right there to recognize that I got paid. Okay, so now let's do some quick check problems. And so what I want you to do is to pause the lecture video, and I want you to do number 63 and number 66 on page 204. I want you to do 67, 93, and 95 on page 205. Number 99 on page 206. And number 100 on page 207. 101 on page 208, and then number 112 at the top of page 209. So I want you to do all those quick check problems, pause the lecture video, do those quick check problems, and then restart it, and then you'll hear me reviewing those, okay? Thanks so much. Hello and welcome back. So let's look at number 63 here on page 204. So we say a promissory note is B. It's a written promise to pay a specified amount of money at a certain date. Okay? Let's look at number 66, a 60-day note issued April 10th matures on, and so this is just an exercise in looking at the calendar. There's 30 days in April. This is on 10th, which means there's 20 days left. 31 days in May, 30 days in June, and then you have to add 9 more to get up to the 90 days. So July 9th, A is the right answer. Okay. Let's look at number 2 on page 205, number 67. Company receives a 10% 90-day note for $1,500. The total interest on the maturity date is equal to our $1,500 times our 0.1 times 90 divided by 360 gives us $37.50. Okay? So remember, it's principal times yearly interest rate times fraction of the year gives you the interest. Number 93, Electron borrowed $75,000 cash from TechCom by signing a promissory note. TechCom's entry to record the transaction is debit notes receivable credit cash. So the right answer would be A, because it does include a debit to a notes receivable. B is accounts receivable, but they signed a promissory note, so that means notes receivable. C, accounts receivable, is wrong because we would credit C, credit to notes receivable is wrong because that's when we get paid. This is a notes payable. That's not what we're talking about. We're TechCom. This would be when Electron pays us. That's what happens. They would debit their notes payable. And then we're not seeing anything about a sale. This is lending money. That's why it's not a sale. Now, 95, the one that is a sale, is number 95, because our pizza company bought $5,000 worth of merchandise from TechCom. Remember, we're TechCom. What is our journal entry as TechCom? We debit notes receivable, and then we credit sales. So B is the right answer for number 95. A is the right answer for number 93. Let's go on to the next page, page 206. Teller purchased merchandise inventory from TechCom on October 17th of the current year, and TechCom accepted Teller's $4,800 90-day 10% note. What entry should TechCom make on January 15th of the next year when Teller pays us? Okay, so we're going to debit cash, right? Because we're TechCom. We're gonna debit cash. We know that because it says paid. We got paid. That means we debit cash. How much do we debit cash for? The principal, $4,800, plus the total interest. So we would figure out the total interest, which would be $4,800 times 0.1 times 90 divided by 360, which is $120. Now here's the thing that's a little tricky, is you have to remember on 12/31, TechCom had to accrue interest for 75 days. Why 75 days? October 17th through December 31st is 75 days. So on December 31st, they had to accrue 75 days worth of interest revenue. So on the 31st, what they did is they debited interest receivable, credited interest revenue. Now on the 15th of the next year, January 15th, that's what this problem is asking for. We get paid our principal plus our interest, and then we credit our notes receivable because our customer no longer owes us any money. And then we also have to credit that receivable for that $100 right over here because they paid us. They paid us. So we did these problems in the notes of the prior lecture video. And then we have to credit $20 worth of interest revenue. Now, how could I get that? Well, I could have taken my $4,800 times my 0.1 times my 90 divided by 360, which would give me $120, which is the total amount of interest, and then subtracted the interest revenue that I recognized in year one, which gives me $20 left over to recognize for this year. Or I could have said 4,800 times 0.1 times 15, because this is on the 15th, 15 divided by 360, which also gives me the 20. And so I have interest revenue of $20, okay? So D is the right answer for number 99. Let's look at number 100. Well, number 100 is this journal entry that I did right here on this page 206, debit interest receivable, credit interest revenue. And again, the way we get that is there's 75 days from the 17th of October through December 31st. So 4,800 times 0.1 times 75 divided by 360 gives us $100. So we debit interest receivable $100 and we credit interest revenue $100. And so D is the right answer for number 100. Okay, let's look at number 101 on page 208. So number 101 is the exact same scenario. It's Teller Company, and we're TechCom, and they purchased merchandise, and they owe us on January 15th, right? And so we did this problem, number 99, right here. This is when they paid us, right? This is assuming that the note is honored. With number 101 here on page 208, we're saying the note is dishonored. That means they didn't pay us. So rather than debiting cash, we debit accounts receivable. Okay, so we debit accounts receivable. E is the right answer. Debit accounts receivable 49.20, credit interest revenue 20. Credit that interest receivable, because remember what they did on 12/31 is a debited interest receivable for $100, credited interest revenue for $100, and so you have to credit the receivable here, okay, to recognize that it's gone, and you move it all over to accounts receivable. So remember, the journal entry to recognize that a note has been dishonored is debit the accounts receivable. So you're moving it from the notes receivable to accounts receivable. And again, the reason that we do this is because when Teller tries to do business again with us in the future, we can look through their credit history and say, you still owe us this money. Okay? And you have to pay us before you do business with us again. All right? Let's look at the last one. Okay? Number 112 here at the top of page 209. So it says on November 19th, Hayes Company received a $15,000 60-day 10% note from a customer. Okay, what adjusting journal entries should be made on December 31st? So from November 19th and through December 31st is 42 days. So I take my 15,000 times my 0.1, my principal, times my yearly interest rate, times my fraction of the year. 15,000 times 0.1 times 42 divided by 360 gives me $175. A is the right answer. Debit interest receivable, credit interest revenue. A is the right answer. Okay. All right, well, I hope you got all those right, or if you didn't, you understand why you got them wrong, and you will know to do better next time, right? Practice makes perfect. A lot of this is just practice, 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 okay? So I'm going to end this lecture video now, and in the next lecture video, we will continue on by talking about disposal of receivables and then accounts receivable turnover. Thanks so much.